Welcome back to The Daily Hunt for Multibaggers, your go-to podcast for AI-generated insights into the market's hottest leads. I'm Ethan, your growth optimistic analyst.
And I'm Brooke, the KPI-driven voice of caution and risk management. It's Tuesday, October 14th, 2025, and we're breaking down all the market chatter and data collected on Monday, October 13th.
We've analyzed a significant number of social media discussions, and wow, there were a lot of different stocks flagged today. Many users were reporting massive gains, which, always gets the speculative juices flowing.
Indeed, Ethan. While there was a lot of community excitement, our AI-driven analysis indicates a pretty risky overall market sentiment. Many of these high-flying stocks are showing some significant fundamental red flags, which means caution is definitely the name of the game.
All right, let's jump right into it. First up, we're looking at IREN Limited, IREN. The sentiment here is overwhelmingly bullish, with our AI analysis giving it a strong positive score. Users are seeing IREN as a company that is already blown up, serving as a benchmark for success. They've secured major multi-year AI cloud GPU contracts, which is a fantastic pivot beyond just Bitcoin mining. This news alone caused an 18.5% stock increase, and there's strong insider ownership, which I always like to see.
Well, Ethan, that blown-up perception comes with a price, literally. The current price reflects strong performance, yes, but the price-to-earnings ratio is an astronomical 164.46. That tells me the market has incredibly high expectations for future earnings. And let's not forget the beta of 4.199. This stock is highly volatile, meaning both gains and losses can be magnified. The debt-to-equity ratio at 53.053 is also a concern for financial leverage.
I hear you, Brooke, but sometimes you have to pay a premium for a company successfully tapping into a booming sector like AI. This strategic shift and the growth narrative could very well justify that premium for investors with higher risk tolerance. This is an upgrade for IREN from its previous stay-away ratings.
Final verdict: buy. Moving on to Rigetti Computing Inc., RGTI, this one unfortunately is a clear stay away. The user sentiment is predominantly bearish, questioning its valuation and the practical utility of its technology. Our AI flags an extreme overvaluation with a massive market cap of nearly $18 billion compared to minimal revenue.
While the skepticism is understandable, some users reacting to short positions did suggest that betting against its immediate upward trend is risky. The news also mentioned potential to soar in 2026 and a recent 25% skyrocket.
Ethan, those are speculative observations, not fundamental strengths. Negative revenue growth of negative 0.416, zero net profit margin, and an EPS of negative 0.88 paint a stark picture. Experts in the field are saying quantum computing isn't even remotely close to doing anything useful. The price-to-book ratio of 32.13 indicates its valuation is pure speculation. It's been flagged as stay away multiple times before, and that rating holds firm.
Final verdict: stay away. Next up, OKLO Inc. Oh, the enthusiasm here. Users are reporting life-changing money from this stock, with some holding since $20 and seeing current prices around $171. There's strong confidence in the nuclear energy sector, and OKLO recently won DOE backing for advanced nuclear fuel projects. That's a huge catalyst,
It's certainly a meteoric rise, Ethan, going from a 52-week low of 9.54 to 171. But let's look at the facts. OKLO is not profitable. Its EPS is negative 0.03, and its net profit margin is 0. That $25.24 billion market cap for an unprofitable company, coupled with an astronomical price-to-book ratio of 36.25, screams speculation. Users are even warning about a bubble and predicting it could be back at $14. This stock has consistently been a stay away in our previous analyses, and despite the euphoria, nothing has changed fundamentally.
Final verdict: stay away. Next up, Bitfarms Limited, BIF. Many users are highly optimistic, with YOLO investments and an aggressive short-term price target of 7 plus. There's strong belief in its HPC/AI play, with one user even calling it the next IREN. Plus, it's a Bitcoin miner, and that sector has been showing some strength.
And that enthusiasm is precisely why we need to be cautious. While it has impressive revenue growth of 87.3, Bitfarms is unprofitable with a net profit margin of negative 0.35 and an EPS of negative 0.6. What truly concerns me, though, is the debt-to-equity ratio of 11.31. That's extremely high, Ethan, indicating significant financial leverage. The beta of 4.4 also confirms its extreme volatility. It's been a stay away in our recent past, and it remains one today.
Final verdict: stay away. Shifting gears to Ondas Holdings Inc., Ondas. There's some positive news here, including an analyst initiation with a buy rating and a $12 price target. They've expanded a partnership with Namo for drone systems and are showcasing new products. That sounds like growth potential to me.
Those are certainly bright spots, but the user sentiment is overwhelmingly bearish, with reports of significant losses from bullish options trades. We're seeing concerns about 20% dilution coming and allegations of market manipulation by Jane Street. Fundamentally, Ondas is deeply unprofitable, with a net profit margin of negative 2.7 and an EPS of negative 0.51. The debt-to-equity ratio is an alarming 20.74, and its price-to-book is 24.62. This stock has consistently been a stay away, and its current fundamentals only reinforce that.
Final verdict: stay away. Next up, American Battery Technology Company, ABAT. Our AI flags bullish sentiment, with one user reporting buying around $1.50 and seeing it touch $10. They attribute this to ABAT trading for dirt cheap and positive news for their lithium recycling business. The company recently completed environmental studies for a major lithium project, secured a partnership with Call to Recycle, and received a major U.S. energy grant. These are significant tailwinds.
Ethan, those are great news items, but the financial metrics are still concerning. ABAT is not profitable, with a negative EPS of negative 0.05 and a 0 net profit margin. The debt-to-equity ratio is exceptionally high at 11.38, indicating substantial financial risk. And the price-to-book ratio of 12.27 suggests a premium valuation that isn't yet supported by solid earnings. Despite the user's impressive gains, for new money looking at the fundamentals, it's still a stay away, consistent with previous ratings.
Final verdict: stay away. Moving on to a heavy hitter, NVIDIA Corporation, NVDA. This one is highly bullish, Ethan. Users are reporting that NVDA was a key contributor to portfolio gains of 365% in 2 years, with one investor even making a crazy YOLO into it. The company is showing exceptional revenue growth of 55.6% and an astounding net profit margin of 52.4%. Mizuho just raised its price target to $225.
You're right, Ethan. The growth and profitability are truly stellar, and it's near its 52-week high, which shows strong momentum. But we have to acknowledge the valuation here. A price-to-earnings ratio of 53.81 and a price-to-book of 45.79 indicates that a lot of future growth is already priced into the stock. Also, the debt-to-equity ratio of 10.58, while perhaps manageable for a company of NVIDIA's caliber, is something to monitor. It's been a mix of stay away and cautious buy in previous ratings, but based on continued performance, I think we can agree on an upgrade here.
Final verdict: buy.
Next, we have AST Space Mobile Inc. Our AI analysis shows strong bullish sentiment from users, with one reporting an astonishing 24K to 390K in 4 weeks. They see it as disruptive, years ahead of competitors, and cite a Verizon partnership.
That's the exciting part, Brooke. A Verizon deal is a huge validation. Users are setting aggressive price targets, some even talking about 800, and believe in 5x more upside. They're focused on the long-term potential for global coverage.
I understand the enthusiasm for disruptive tech, Ethan, but for all that hype, AST is deeply unprofitable, with an EPS of negative 1.86 and 0 net profit margin. The price-to-book ratio is an extreme 26.14, meaning investors are paying an enormous premium for future unproven growth. And the debt-to-equity ratio, a staggering 43.67. One user even admitted their account was chopped up into dust from options. We've rated it stay away or speculative gamble previously, and that remains the case.
Final verdict? Stay away. All right, let's talk about D-Wave Quantum Inc., QBTS. This stock was another star performer in a user's portfolio that saw 365% returns in 2 years. There's talk of it being a millionaire maker stock in the quantum computing sector. That's a high-growth industry, you know?
High growth, perhaps, Ethan, but also high risk. D-Wave Quantum is fundamentally unprofitable, with an EPS of negative 1.13 and no net profit margin. Its price-to-book ratio is 19.88, which is incredibly high for a company losing money. Plus, it has a substantial debt-to-equity ratio of 5.76 and a beta of 1.48, meaning it's volatile and not financially stable yet. For new investors, this one is a stay away.
Final verdict? Stay away. Next up, TMC, The Metals Company, Inc. Our AI picked up some serious bullish sentiment. One user reported a 413,000 gain and sees it as a long hold, believing the US government will buy into deep-sea mining to get ahead of China. They think we'll be balling out of control in a few years.
That's a bold prediction, Ethan. While the stock has seen a significant run-up, currently near its 52-week high, the fundamentals tell a different story. TMC is unprofitable, with a negative EPS of negative 0.38 and zero net profit and operating margins. The price-to-book ratio is an astonishing 51.89, which is just unsustainable for an unprofitable company. It also carries a high debt-to-equity ratio of 3.03. For us, this is a clear stay away.
Final verdict? Stay away. Moving on to Robinhood Markets, HOD. While some users are making YOLO plays, there's significant community concern. One comment stated, "My brain says that a stock up over 260% in a year is overpriced and due for a major correction."
But Brooke, some believe its recent trajectory suggests it's likely to continue upward. Wall Street analysts seem optimistic, maintaining market perform ratings while still increasing price targets.
True, Ethan, but even the updated analyst target of $121 is well below its current price of $140.68. The PE ratio is a staggering 71.41, and its PB is 15.48. Combined with a beta of 2.43, this stock is highly volatile and significantly overvalued. Robinhood has mostly been a stay away recently, and that assessment holds today.
Final verdict? Stay away.
Let's discuss Tesla Inc., TSL. This stock was also highlighted by a user for contributing to a good year, with one investor even saying a YOLO into TSL gained confidence. Analysts are calling it a must-own and one of the best growth stocks.
Ethan, the enthusiasm is there, but the numbers are loud. Tesla has an extremely high PE ratio of 256.41, and despite that, its revenue growth is negative at negative 0.118. That's a serious red flag for a company valued as a growth stock. The debt-to-equity ratio is also very high at 16.82. For us, this remains a stay away. It's been on that list a few times before.
Final verdict? Stay away. Next, Webbull Corporation, BUL. Our AI finds the sentiment overwhelmingly bearish. Users are calling it the biggest piece of shit award and noting sentiment is horrible.
I saw that post about someone's retirement plan is doubling down on BUL 15 leaps, showing some conviction, at least from that individual. And sometimes stocks at basement lows can bounce back.
The data, however, indicates deep fundamental issues. Bull is unprofitable, with a negative net profit margin and an extraordinarily high PE ratio of 78.27 for a company losing money. The debt-to-equity ratio is a shocking 15.02. It's trading near its 52-week low after a massive plummet. This is unequivocally a stay away. It was a stay away last time, too.
Final verdict? Stay away.
Next up, Open Door Technologies, Open. While a few comments express short-term bullish hopes, the general tone is a cautious one.
Cautious is an understatement, Ethan. Users are calling it a meme stock and describing trading it as gambling due to extreme volatility. There are serious allegations of market manipulation by Jane Street, and a 20% dilution has been mentioned. Fundamentally, Open Door is unprofitable, with an EPS of negative 0.43 and a deeply negative net profit margin. Its debt-to-equity ratio is an astronomical 346.12, and its beta is 3.60. It has been a stay away multiple times in the past, and it continues to be one today.
Final verdict, stay away. And finally, Cipher Mining Inc., CIFR. This one, Brooke, is showing very bullish sentiment from users. One investor reported being up 125% on the year and 300,000% in the last 3 months on CIFR options. They're letting positions ride, convinced by its AI prospects and Bitcoin production.
Ethan, those are some incredible reported gains, but we have to dissect how they're achieved. CIR is unprofitable, with a net profit margin of negative 0.97 and an EPS of negative 0.45. Its debt-to-equity ratio is an extreme 25.28, and the price-to-book is 10.51. It's trading near its 52-week high, meaning much of that run-up is already priced in. While linked to AI prospects, fundamentally it's a highly speculative play, and our AI flags it as a stay away. It's been a stay away in our past ratings.
Final verdict, stay away. 3. Today's candidates for deeper analysis.
All right, Ethan, time to compile our list of candidates for deeper investigation based on today's AI-generated insights.
Investigate as buy. IREN Limited, IREN. NVIDIA Corporation, NVDA. Investigate as cautious buy. OKLO Inc., OKO. Investigate as speculative gamble. AST Space Mobile, ASTS.
This podcast is for informational and entertainment purposes only. The content is generated by artificial intelligence and does not constitute financial advice. Listeners should conduct their own research or consult a licensed financial advisor before making investment decisions. We are not responsible for any losses incurred. The market is a wild place, and knowledge is your best asset.
Absolutely. Thank you for joining us on The Daily Hunt for Multibaggers. We'll be back tomorrow with more market commentary.
Until then, happy hunting!